Rising unemployment and falling share prices are just a few of the things that assailed retailers earlier this year. However, things seem to be looking up. Today, we have Morningstar senior analysts James Cooper and Peter Esho with us to discuss whether retailers really are back in business. Gentlemen, welcome.
Hello, Vicki.
Hi, Vicki.
In your retail sector report, you mentioned that consumers have faced considerable headwinds, but are we seeing signs of relief on the horizon?
Well, Vicki, I think to quite a large extent we've actually had some relief. We've seen some relief already. There's been some considerable help to the consumer from stimulus packages. Interest rates have fallen a long way. The whole sentiment of the sector has picked up a lot. Going forward, there might be further small stimuluses which can help the consumer. But, I think we're running out of that sort of ammunition now. Interest rates have probably bottomed where they are now. There's been some signs of interest rates actually lifting. Fixed mortgage rates have come up slightly. So, I think that things actually might be getting a little bit harder rather than easier going forward.
Over the past few months, Australia's unemployment figures have been rising. James, how do you see that trend going?
Well, as always, we have some retailers who sell staple goods, the supermarkets in particular, who will continue to deliver pretty solid sales, and that's where we expect, where we really recommend investors keep their money in the retail sector at the moment. Across at the other end, at the more discretionary end of the spectrum, I think things could get a lot tougher again. Another point to bear in mind is the savings rate, which over the last decade has been unusually low. In the 90s, it averaged around 6%, and overall, over the last decade, it's been close to zero, and that is bound to change going forward. Consumers have been very, very bullish and positive about their futures for a long time, with unemployment falling and falling, interest rates falling and falling. Even if those things don't reverse too badly in the other direction, those gains aren't going to carry on accruing. So, the Reserve Bank is forecasting the savings rate to return back to that 6% level from next year onwards, and that could continue for several years. So, that has to have a softening impact, particularly in the discretionary area.
Peter, the retail sales data for May was much better than expected. What drove the increase?
Well, Vicki, really, we've seen May continue. We've seen a strong May continue from a strong April and a strong March, and that's really consistent with the federal government stimulus package. You've seen a lot of money being flushed into the economy. January and February were a little bit soft. March was a little bit soft, but particularly towards the end of March, a lot of retailers started reporting some very, very nice numbers. And if you look at the composition of the May retail sales, you're really seeing smaller ticket item segments of retail do well. Home furnishings and the larger ticket items, were a little bit challenging. But the smaller items, the cosmetics, the apparel, things around $100, $200, really look to be doing okay. And if you look at the size of the stimulus money that's been going out, $900 for those earning under $50,000. If you assume half is saved, half is spent, that gives you about $200 to $500 being spent over 3 months. So that's consistent with the data we've been seeing.
So we know that the government stimulus money has helped department stores. Does that include David Jones? And how are they going these days, James?
It tends to be the upper-end consumer shopping at David Jones. But having said that, that wouldn't be only the case. So there would be many people shopping there who would have used some of that stimulus, I think. But sort of more indirectly, the stimulus has boosted sentiment in the sector, and that has lifted the whole share market, which is a strong influence on buying behaviour of David Jones customers.
And in the consumer electronics sector, how are they faring?
Yeah, good question. In consumer electronics, you've basically got two major listed players. You've got Harvey's, which is more diversified, larger ticket items. They do furniture, bedding, bathrooms, more home furnishings across the board. Then you've got JB Hi-Fi. And JB Hi-Fi tends to have an average sale price of around $100. So while they are in the plasma screens, home entertainment, or audio, visual, that sort of stuff. There is two types of consumer electronics. JB Hi-Fi has been reporting very strong numbers. And again, $100 to $200 is easier to spend than spending $5,000 on a new plasma TV or on a couch or on a bedding suite. Whether that growth continues and that trend continues is going to be the real question in 2010. For JB, we're forecasting a little bit more of a challenge in 2010. The large operating leverage in that business could potentially see profit growth really slow down from what we've seen over the past few years. And for Harveys, I think they'll be able to travel out of this recession. We were pretty positive on the stock when it was touching near March lows, and it's bounced nicely since then.
Gentlemen, is there any takeaway message for retail investors here?
Yeah, I think our view is a little bit of a bland one. You know, we think you should really tread a little bit warily next year. So, you know, focus on the big solid retailers, and the discretionary stocks have had big jumps recently, and I think you know that's nice for investors who have been well positioned there. But there's a danger that you know, perhaps the institutional investors have made a bit of a crossover from the more boring safe stocks and are trying to ride the more of the cyclical upturn and don't want to be left behind. But I think that's a slightly dangerous strategy at this point.
It's going to be a test of good management, I think, 2010. The really good, well-managed stores are going to shine, are going to be able to trade through a very tough year as unemployment rises, and those which have vulnerabilities will be left exposed a little bit. We like the reject shop. The target demographic is very resilient. They've still got a lot of growth. Their management has a very impressive track record. And then, I mean, if you do get a pullback in valuations and in the market, you've got guys like Premier Investments, which have $300 million in cash, managed with the watchful eye of Solomon Lew. They've got Just Group, the Just brands in their portfolio, and there could be a lot of good opportunities for guys like that.
Gentlemen, thank you for your time with us today.
Thanks.
That's a pleasure.